Welcome back, everyone, to Vox Markets. My name is Paul Hill. I'm delighted again to be able to speak to Abby Glennie of Abrdn, one of the UK's finest small and mid-cap investors. So welcome, Abby.
Hi, Paul. Thanks for having me back.
Yeah, well, it's been surprisingly resilient, the markets, and positive, actually, in the first 4 months of 2023. So looking into sort of like through the crystal ball into later in the year and into 2024, what's your sort of outlook for equities?
Yeah, so I mean, I actually feel reasonably positive about the UK market if I think ahead to the next year. So I think one of the challenges that we see is really just a lot of sentiment-driven aspects. But I think when you look at a lot of the underlying data, it's actually been very positive for quite a few months now. And it feels like we're in a very different environment to if we think back to October, November, we had that really sharp market rally. And actually that was at a point where everyone said the UK was going to this sort of deep recession. Bank of England said 2-year recession. If we look at the data that we've seen since January, it's actually been pretty resilient. I think for me as an investor, one of the key aspects we've seen is the strength of the consumer. So, as soon as we came back after everyone's Christmas break, I think everyone was really, really nervous about anything consumer related retail. And actually they've reported really, really well. So despite the sort of cost of living crisis, a lot of the headlines as well around that, which I think drives sentiment probably maybe more than reality. We saw the retailers report well. We've seen travel and leisure companies report well with good forward bookings. And I think there's quite a lot of reasons to believe that the consumer stays quite healthy. So we've got full employment really in the UK. And if you don't get a recession, it's hard to see how that changes. We've had, good wage inflation. Obviously, we see a lot of the headlines around public sector, but actually a lot of the data I've seen on both private and public sector has been pretty reassuring in terms of wage inflation over a number of years. This is just my personal view, but I also think we have a slight change of lifestyle post-COVID. I think people's attitudes to let's say holidays and spending has maybe changed a little bit. And also the savings ratio in the UK is still quite high. And we have seen some, I know looking back to 2016, we saw sort of people correct that a bit, so bring that down a bit to boost their ongoing savings. And actually, if we just saw people take the savings ratio down to, let's say, where it was in 2019, I think even in our sort of cost of living environment, we could see some pretty healthy spending outlook. I think consumer picture is actually pretty good in the UK.
No, I mean, I'm with you. I think it's certainly when it comes to sort of like the sort of consumer, etc. If they're not sort of like having to commute every single day, they're saving obviously a bit of travel and they're pocketing that, and they're not spending on expensive lunches and dining out in the evenings. That gives them a bit of a. What's sort of like the momentum? Do you think I mean, obviously it's been very strong in Q1 into Q2 and then into Q3. If the Bank of England it lifts interest rates later this month, you've obviously got the Fed as well, and then I mean, you just hear the headlines. There aren't many headlines of mass sort of recruitment campaigns. It's all sort of like the other way at the moment, not in the UK, but certainly on the other side of the pond.
Yeah, I mean, we've seen a lot of that with companies in terms of particularly big US tech companies, things like that. We've seen big headcount cuts. Actually, what I hear from businesses now who I've spoken to who are probably customers of those, actually that feels like we probably had a boost. We've had a boom period through COVID for a lot of those businesses. So rather than actually things being really depressed, actually we're probably just making more of a correction from those sort of, I don't know, over elevated levels. So, and we're seeing that actually normalize again, I think, a bit. I think it's hard because we talked a lot to clients last year about, and this is probably where we were too cautious. If we were sitting here last summer, I'd have been more cautious about consumer spending, which, feeds obviously into economic data. I think what everyone said was everyone will have their last summer because they haven't had a summer for 3 years. So everyone will go on holiday, everyone will spend normally, wait until September that was when people's real energy bills were hitting. Mortgages are a bit different because everyone has a different, for homeowners, everyone has a different length on a different month. So you don't have like a cliff edge on that. And obviously, we've seen rents go up as well. The PCP car stuff is the other interesting one. I think those roll off. People realistically have the option of paying more per month or having a lower quality vehicle. But I think, like, whereas if we'd spoken in September around those things, I was more cautious or negative, I guess, about how those were going to impact. I just think we're almost, I don't know what, we're like 8 months past that now, and we've still seen that resilience. So as much as you could worry that in Q2 and Q3, and I've had a lot of these discussions, that things are going to get tougher for the consumer, I think we're past the worst test. I'm not saying it's all easy. I'm sure retailers are having to work pretty hard still at sales. But I think we've seen some surprising stats out of companies as well. So like, I've seen some interesting feedback from companies around actually some of the areas of strength they're seeing are the areas that actually, you know, if you read the newspaper headlines, we tell you are being most squeezed. So yeah, I think look, it's not without its risks. So there's definitely still risks on that economic data. But I feel reasonably optimistic. I mean, the interest rate pathway, I think, although there's question marks around some small further hikes, actually, you know, it feels like the pathway in terms of then a cutting cycle, whether it be, you know, a couple of years, is reasonably well known by the market. And I think that's really important as well for like sentiment and market levels. It's the unknown that is the real killer usually in markets. You know, people adjust to known levels. Companies can plan at certain, you know, known pathways of interest rates and inflation. It's the surprising delta, you know, which is what we saw in the first half of 2022. That's just so difficult to manage.
Yeah, and I think you're right. I mean, if the market can actually sort of like cope with another sort of mini banking crisis as well, and sort of like all the wall of worry that the big merchant banks have sort of like been publishing in the last sort of 6 months, then underline there's a lot of solidity there, no doubt about it. And just turning to sort of like, we've had a lot of M&A actually recently, and also we've started to see a bit of delisting risk as well. I don't suppose you could just sort of comment on both of them, because how you see that going forward, whether, because I mean, obviously there's a lot of good value actually in the UK.
Yeah, and I mean, I guess the one thing that it's almost, I think, frustrated clients is that people have just pushed to them for, you know, every quarter for maybe the past 2 years, like the UK's cheap, look at it versus other geographies. And I think what investors are looking for in UK markets now is, okay, that's fine, but what is the change that's going to actually make a difference? You know, what are the factors that we should look for? And I think on that valuation side, we've probably seen two testers. So I would say one would be actually, like, we saw a sharp market rally in September, well, end of September, October. I think the UK market tested levels at that point. So I think that's been interesting for sort of valuations. And I think more recently, you know, we've seen quite a lot of bids for UK companies. So the ones that come to mind for me recently would be Deca Pharmaceuticals. That was almost a 50% premium. We had Medica, this small cap business. That was a 35% premium, I think.
That was last week, wasn't it, Medica?
Yeah.
Well done.
Know, these are interesting businesses. Other Numis got bid for.
Yes.
This week, you know, attractive premium by Deutsche Bank. We saw SureServe, a small UK, we don't own that one, but a small UK home services type provider. And I think this is like, as much as these are, you know, some of these are great businesses and you definitely don't want to see, you know, loads of things exit the UK market, let's say through bids. I think in terms of sentiment for driving UK markets is really important. And don't forget that, like, even in mid caps, if I look at FTSE 250, half the revenue is generated overseas. So I think in terms of, you know, we can compare, if you compare valuations of UK markets and overseas, but you still have a negative view on the UK economy, which some people might have. You know, I think the difference is you need to remember that like half of that revenue is actually overseas. So, you know, some of the parts type argument on the UK market is pretty attractive.
Yeah. And what about the sort of, we are starting just to sort of touch on the sort of the delisting risk, because we had iEnergizer, which got taken. Admittedly, it was a bit of idiosyncratic, but there was certainly a lot of companies that delisted in the great financial crisis as well.
Yeah, and I suspect often they're probably quite sector focused, you know, in terms of the names that delist. I think there's a huge governance thing around how companies delist. And, we'll probably see more of that obviously in the AIM market.
Yeah.
And I think it's just something that investors should be just very cautious about where you're involved in companies where you think there's a risk of that, because it's very different to a bid. If the governance isn't quite right and shareholders are unfairly treated, because generally there's often a big stakeholder, maybe a founder, backer, you got to make sure you're a bit all over that governance so it doesn't happen at the wrong price.
Yeah, if you're an investor, watch out for sort of like very heavily loaded sort of like individual owners of companies on AIM, because
yeah, but you say that, it's interesting because I think we also have some great businesses like that. So I've got some great AIM listed businesses with big shareholder founders. I mean, the biggest percentage is probably in like global data.
Yeah.
And I think I have what I think is quite a good relationship with the management team there, and a really good understanding of his motivation for being a large shareholder in that business. I've had discussions with him around liquidity and willingness to sell down. So I think it's also, if you're like involved in things like that, you just need to put in that that additional insight in terms of just making yourself comfortable that you aren't going to get caught on the wrong side of something.
Yeah. Particularly if the sort of like the heavily weighted owner decides to delist and then flip it to somebody else off market at a higher price. But anyway, it can occasionally be the Wild West of AIM, but that's the area I invest in. Now, just turn into sort of like new positions you've been buying. FDM Group, which is a sort of like an IT services business, consultant business, I think. Do you want to take us through this one? Because it's obviously digital services and digitization is a really strong secular growth trend, but you did surprisingly see it's a tiddling stock, but it was Made Tech this morning had a profit warning about public sector IT, saying it's seeing a shift to the right for some of its contract rollouts.
Yeah. So I think that I looked at the Made Tech thing this morning actually, because it's one we've never owned, but we do own Genus, which is I would say a much bigger, higher quality peer. And we've heard from Genus probably 2 weeks ago or something. So I'm very confident about their outlook. And I think it's just what Made Tech talked about is something that we have seen across a range of sectors. We've heard sort of tech digitization companies talk about it, is delayed decision making. And I think Made Tech particularly pulled up on the public sector and around the public sector end of year budgets. I think it's where you've just got to be a bit aware about where you've got that big customer concentration and lumpier workloads. Whereas actually, Genus reported really well. Their shares sadly still went down on the day, but when they reported, really strong numbers. I think they're feeling very confident about the outlook. The only slight weakness they were seeing across the business was the NHS, where they did see a bit of that delayed decision making. But I think more broadly, they're seeing strength across all the areas of businesses. And the other one we own actually, which has public sector IT outpool, is Bytes.
Yes.
So their business, Phoenix, is public sector. And also, they're seeing real strength there. So Made Tech looks to be a slight differential, let's say, in that.
Yeah, just on the valuations of both. You've got FDM on about 17 times and you've got Bytes on about 23 times. Is that's reasonable given the growth rates you'd expect on the earnings, is it?
Yeah, I think so. I think the market's definitely been a bit more conscious about higher PE stocks at the moment. So, I think if you look at the dividend yield though of FDM, it's probably about 5% now.
Okay.
And I think, FDM definitely, it's interesting because it sort of has a range of different specialties, but I think one of the key things about them is how they've diversified. So diversified through geography, really great blue chip client list now. They're continuing to see, they call them Mounties.
Yes.
So they continue to see, still really good demand across different sectors for Mounties on hire, as such is the phrase. I would say when they spoke in February, must have been, we maybe saw a slight softness in just some areas of that. I would also call it sort of decision making. But I think they've got a lot of visibility still. Now I think it's quite attractive multiple, good dividend yield, and they're still seeing a huge number of applicants as such in terms of, so they're really train and develop people.
Yeah, and they've got rock solid balance sheets. They've both got a big chunk of cash on the balance sheet.
Yeah, I think, and that's important. It's important also to customers, you to know that those people are, when they're taking essentially like, contractors, consultants, they're from a very secure, financially backed business. I think as well for FDM, in an uncertain macro environment, as much as you could worry that corporates sort of pull back on projects and that impacts their demand, actually, I think you also can see the opposite from some, which is that where corporates don't want to hire full-time employees themselves, especially for what's often quite sort of specialist niche skills and project sets, actually using someone like FDM, I think is a really good way for them to not make long-term capital investments as such.
Yeah. Yeah, and I think, as I say, I think the secular tailwinds for anything cloud, but particularly we're going to get another second wave coming now for, regenerative AI. So, the artificial intelligence, that's just going to, I mean, every company needs to have a strategy to do with artificial intelligence.
I've had some good chats with companies recently about Chat GPT.
Yeah, well, it's a cracking service. I use it myself to do a bit of research. Now, just switching gears, still in tech, but Spirent, or Spirent, you've actually sort of take a position there or added to position, and that's sort of all things telecom, handset testing and device testing, wireless and stuff like. Do you want to take us to this one, because it's been a real sort of like trophy asset on the market for ages, and it's still only trading at less than 15 times. Yeah,
and also another one with a really good balance sheet.
Yes.
I think if you cash adjust that valuation, it's pretty so Spirent is one we've held in some funds for quite a while. We've added it to some other funds more recently, and unfortunately the timing of that hasn't been great. So this is a business which I think over the past sort of 2 years or so until like November had really actually started to prove itself. I mean, it's a business that I've known for I don't know, well over 10 years now. And I think under the current management team, it's really improved its sort of market positioning, its product pipeline, importantly as well, its sort of cost control and also visibility. I think the way that they've added sort of more, so they have some more software type sales, and also I would call them sort of value add product bundle type element. So I think the visibility and the relationships with customers has really improved. And the big driver for this business is 5G infrastructure.
Yes.
And 5G is something which is just going to go on for years and years and years. What we've seen more recently has been disappointing, is we've just seen that delayed decision making again. So I'm confident that it isn't lost business. I think we've heard the same sort of messaging from peers like Keysight, and also like 5G infrastructure is something that all these big telco providers really have to invest in. And importantly, if you think about the big US carriers, once one or two start to invest in that, you can't lag in this space. So I think there is a continued, not such a wave of investment, but let's say a continued spend on 5G investment to come for years and years and years. I think Spirent's really well positioned for that, but I think we're in a bit of a hiatus period in terms of how long these people can just sit on, more discretionary areas of spend.
Yeah.
And just push things back a bit. I do think, I never own stocks because I think they're going to get bid for, but I'd put Spirent up there in terms of it's got to be an attractive asset in the space it's in, which is, in all the time I've looked at the sector, there's been just consolidation and consolidation. And these guys sitting here, quite an attractive valuation, net cash balance sheet. I wouldn't be surprised if some people were doing the numbers on it.
Yeah, no, I'm with you. I mean, it just stands out like a sore thumb. That's why I called it a trophy asset, because it's one of those unique sort of like properties that somebody's going to be well sought after. And I guess if you get a new product cycle, in terms of it may be, Apple puts out its new, sort of headset, etc., or you get something at this, as I say, at the edge with the 5G in terms of, automotive or something like that, or wearables. I'm not sure, whatever it is, but you're right. It needs to probably, if it gets another new product life cycle, it should do really well. Now, Ricardo, which is, I think, is a high-end consultant for all things sort of engineering and environmental, and it makes really well. Actually, the margins are reasonable, but it's again sort of like a good, profitable, growing business.
Yeah, and so Ricardo is something that we have owned before. we probably haven't owned it for about the last 4 years or so.
Mm.
And I think for anyone who knows Ricardo from that time period, it's actually quite a different business now.
Okay.
So people probably used to historically know it more around some of the work that they did with automotive,
Yes,
defense, that sort of space. Really, I would say like the strategy that we sort of first started speaking about maybe 4 or 5 years ago has really come to pass now. So this business is really well positioned as essentially, a lot of it is ESG consultancy. It's related to that in terms of environmental and engineering consultancy, but they do a huge amount of work for like UK government, for the European Commission, for regulators. And I think what's really important about the framework of this consultancy is just the whole end-to-end proposition they have. So I think they have insights from a whole different range of areas, which means that they can really provide that end-to-end proposition in terms of, whether it be writing strategies, pathways, government implementation, actually into how you actually implement all these things. What are the outcomes? How do you measure them? And actually at the same time, like we've still got a bit of exposure to, so they do the McLaren engines, for instance.
Oh, right. Okay.
Yeah, so
they are high end then.
yeah, definitely. The stuff they do in automotive tends to be, on the higher end side of things, and a few other lovely brands in the high end space. But that's not where the capital is being invested. Yeah. And they do a bit of work in defense actually as well. So they've got a really good proposition there, which actually gives good visibility in that area. But as a business, I think they're really focused now on being low capital intensive. So that consultancy business, and I think it's very scalable. Your key thing is hiring people and people with the right skill set. But I think it wants to be low capital business. I think it's going to be a high return on invested capital metric going forward. I think those margins are also going to improve. So even if you just think about the mix shift that they're going to have, if you look at the differential growth rates across the business, I think we've got quite a lot of visibility on that margin improvement.
Yeah, you'd certainly think that actually margins should improve, because you've got those guys at the moment seem to be on about 8% EBIT margins compared to FDM on 15 plus, and actually Bytes Tech is 30%. So
yeah, I mean, I guess all quite different businesses there.
Yeah, it depends on software.
Well, for Ricardo, I mean, it is quite a unique business now in the UK, because another space that actually we've seen a lot of consolidation through the years. You look at things like what was the WSP and Atkins, businesses like that, and if you look, comparative to that, I think there's quite a lot of potential.
Yeah, good. And one which is sort of like another trophy asset that's perennially put under the microscope of bidders is GB Group, which is obviously all things sort of digital location identification, and I think it does it for sort of like all kinds of e-commerce transactions, gambling, and crypto and stuff, making sure that it's a prevention cybercrime. It should take us this one, because the shares came down a lot and then have actually bounced just recently.
Yeah, so I mean, GB Group has been a challenging one for shareholders. So it was bid for by US private equity firm, and they essentially then stepped away from that. They were able to come back again in April. We haven't heard anything from them again yet.
Oh, okay, that's interesting.
I think people definitely think it's another asset which, on valuations it's on. There's got to be a few people in that, either in private equity world or potentially other sort of trade buyers, who must be looking at this. I mean, the thing that's challenged the business most in the past year or so is they just had downgrades after downgrades, which has been really painful for shareholders. And I think the biggest area of that is cryptocurrency. And this is another part where, I think if we look back to some of the boom things that we had in COVID, I definitely put that. So they people signing up for new cryptocurrency accounts is key in terms of business for them. And I think what management did poorly was their judgment of what was the base of cryptocurrency. So they saw it declining, but I think they were very poor at judging, what was the lowest it could go to, where was your base in that business. And so actually that's just, frustrated investors, because every time they've reported, through last year, we just had worse news flow on that. Actually underlying, lots of the other areas of the business are doing really well. And importantly, like there's a well invested sort of strategic platform, data integration, everything in there. Quite a global business. So I definitely think it has like a strategic fit for someone, but it is hard at the moment to see what's going to drive the UK market, let's say, and shareholders to really re-rate that in the short term. It's sort of, it feels like it's stabilized.
Yeah, okay. I mean, I know it's probably got some exposure to the online sports betting in the US, and you'd thought that given the growth of that and the deregulation or the regulation of it throughout the states, etc., then that's got to be a big plus, you'd have thought, just in terms of.
Yeah, I mean, these guys have there are a whole range of different sectors, and that's been a positive in some ways. So, like for instance, in COVID, like for instance, the work they did for the travel sector, fell off a cliff. That's obviously now recovering. They do a lot for people around financial services, actually around recruitment. So, where companies are verifying new employees, things like that.
Yeah, good.
It's quite broad, which helps actually.
Good. Okay, well, let's move into the media world. LBG Media, which I think is effectively a youth online publisher that was listed about 2 years ago. I did notice actually one of its competitors potentially going to bankruptcy, which I think is Vice Media. I saw a headline in the Guardian today, so it could be that this sector. Do you want to take because it could be the strong get stronger and the weak sort of like fall away.
Yeah, so LBG Media, people probably better know one of its brands, which is Lad Bible. Actually has a range of probably about 10 brands. It includes Unilad, actually, which they acquired years ago. Things like Tylab, which is a more female-centric. But you're right, their sort of target audience is probably kind of 18 to 25-year-olds. Actually, the thing that surprises people is they have a really high percentage share throw in female audience. Okay. Yes. So people think of it as being quite gender biased, not nearly as much as you think. And I guess what do people, I think because people know maybe Lad Bible, they think about this business in a certain way without really looking at all the detail. Actually, so I think that this business has been really, really strong underlying ever since it's listed. The thing that's gone against them is last year sort of advertising pricing. So that hit the whole, lots of players across the media space, and they were never going to be immune to that. So if you're growing your volumes really, really strongly, but your price per volume, per unit, is going against you. I described it to them as it's like you're running on a treadmill backwards. But I think actually, look, half of this business is direct and half is indirect. So LBG is actually a really, really big like content creation publisher. And so in the direct business, it provides a lot of revenue visibility. So they work with loads of big brands, creating their content. And I think, that one, they've got a really good reputation at it, but two, I think they have an understanding and a way of capturing that audience in that, 18 to 25 category that is just unique across players. So I think they've done really well there. I mean, some of the best known, like they do all the British Army, for instance, content creation, and a range of different brands. So I think that direct business is actually really strong and visible. I think the indirect is where, look, they're doing really well, but you just need pricing to sort of correct, and we have seen that stabilize. So essentially what they're doing is they're creating video content that is going on mostly social media platforms, and they're monetizing that. And we've seen them really adapt to different environments as well. So short form video has become really popular. So it used to be like on Facebook, videos had to be a certain length and you could only monetize that, so far into it. Actually, the advent of TikTok, where people watch much shorter videos, has changed that whole dynamic. So, Facebook have worked with LBG to adopt that. So now you can create sort of much shorter videos and you monetize them quite quickly. So that's been a real positive for them. And I think another big upside is that at the moment you cannot monetize videos on TikTok or Instagram.
Yeah.
But I think that's something that those owners are definitely looking at and considering. And LBG is actually the #1 publisher on TikTok. Usually, you've got this like captive audience that if that monetization gets turned on, it's like instant revenue stream for them.
And it's got
one with a great balance sheet as well.
Yeah, I was going to say it's got a great balance sheet. Yeah, no, it all ticks all the right boxes.
Also, founder run as well, which is another thing we love.
It's what? Sorry,
founder run.
Oh, okay, yes.
Yeah. So Solly and Arian created that business and have taken it, to I think an amazing business now and a great size.
Good. Okay, well, let's move on to animal health. And you've got three here, actually. You've got sort of veterinary services business, CVS. You've got Genus, which I think is all to do with artificial insemination of cattle and pigs, and if you put politely, and Pets for Home, which is probably the UK's biggest retailer of all things sort of like companion animals. Do you want to take us through this? Because I guess it gives a lot of solidity to the business and visibility.
Yeah, so I mean, I would say all those businesses are quite different. And also, I mean, we also have a bit of debt crunch on funds as well, which has obviously recently been bid for. So, yeah, okay. I mean, I think actually CVS shares have been quite strong recently on the back of the DECRA bid, I think. So it is a space of consolidation. So I wouldn't have said DECRA was top of people's lists to be bid for things. Yeah. Actually, CVS is in much more. So CVS, basically UK veterinary practices and other services, and that is getting to be a consolidated space. There's a few big private equity back type players in there in CVS, but that's a business which I think I would say, look, now I probably think of it as an attractive growth compounder. I think under current management, it's really well run. I think they've got over a lot of the issues the business had historically around veterinary availability, around pay, around the ability to sort of drive these businesses forward. So you were seeing it continue to, deliver attractive margins. It's got pricing power. Yeah. As we're seeing across the industry. So, it's not like they're anyone standing out in pricing. I think they'll continue to do some consolidation in the UK, although the CMA did step in on some. Right. So I just think it's just a local regional problem. So I think they now understand what the CMA are looking at, and so they have a much better view of what deals will work and what won't. Yeah, no, I mean, looking at we've got 3 cats, and the amount of money we spend on vets bills is enormous. So you don't sort of like penny pinch. It's basically okay, we'll pay the price, okay. Yeah, and I think you really want veterinary insurance. Is my advice for any pet owner, and that's where people like CVS and Pets at Home will help you out. Pets at Home is, I would say actually what's a real driver of those shares. It's really the digital innovation they're making across the business, and just how much that's helping them to improve operational fundamental performance, really understand their customer. Drive share of wallet as well, because I think a lot of pet owners actually, like they spend their wallet share on their pet in different locations. Actually what Pets I think is really understanding now is how to attract more of that wallet share. So they have obviously their vet business, they've got grooming, actually, you can do food subscriptions, etc. So I think we're also past that the biggest step ups, let's say, in their investment. And ever since, I remember they put out like attractive targets for growth dynamics maybe a year ago or so. I mean, I think they'd increased those within 6 months. So they really are performing very well. And Genus is a very different one. So Amanda and me actually went to North Wales. Okay. Ruthin, I think is how you pronounce it. Okay, yeah. And to see the ABS business, so essentially the beef part of the business. And if ever a site visit is going to really bring a company to life for you, definitely fun. It was, we learned a lot in that day. So I appreciated the management hosting us there. Yeah. But, it's quite a different business to anything else. And I would say that's one of the best things about it, is truly like a global leader in what they do. Yeah. So I mean, they're focused on the sort of porcine and the bovine markets. I think in the porcine market, there's a big opportunity in this PRRS resistant program that they're working on, which is essentially going through sort of approval process at the moment. I think increasingly people are more confident that gets put through, and we're probably talking about an 18-month timeline now. I think that is a potential big positive asymmetric risk, I would say, on future earnings. And it wouldn't be instant, it would be over time, but future earnings, but also sort of valuation driver of the business. Meanwhile, we've got, really good underlying drivers across the business in terms of Chinese strength, I think returning in the porcine business. So it's definitely a business which has proved quite lumpy, particularly by China. So they've had really sort of super normal profits in China, which they were always clear, to be fair, would be super normal. But we've seen a lot of volatility year for year. And I think that has been like an even bigger driver to share price and rating than it even has to sort of profitability. People have really swung on that. But actually it feels like now the underlying drivers of that sort of area are more stable again. They've got some really good products across the bovine business. So beef on dairy, sex, semen, and importantly, really, really global business with good relationships into all sorts of markets, whether it be India, Brazil, the US.
So with the, just from my understanding, so within the cattle area, they can specify which they inseminate with the relevant semen, etc. They can tell which sex wow, absolutely. I never realised. That's incredible.
Yeah. So I mean, historically, I'd always, I think, been more around like the genetics that make you breed an animal of the characteristics, let's say, that you're looking for. So if you go and see the different bulls, I mean, not only are they different breeds of animal, but they are, incredibly different in terms of what you would want for, whether it be like a certain types of really high quality steak bull, for instance.
Yeah.
But no, now, so the sex semen is really interesting because, particularly you can imagine some types of farmers will obviously want to make sure they have female cattle. Yeah,
you want dairy or beef.
Yeah, so I mean now, and we saw the whole thing in process, let's say, but it was really interesting. So essentially, they're taking the specimen and through in their little sort of laboratory that they have. They have technology where it essentially firstly sort of, let's say, cleans up and makes sure the quality is there of what they're processing. And then literally through sort of very advanced science is eliminating the what you don't want, let's say, so that you're left with only female sex semen.
Okay. Wow. God, amazing. Well, I mean, you learn something every day. But I'd point to investors, this is quite a sort of like a feature actually of your portfolio. You've got best in class sort of like trophy assets throughout that actually, if they ever have a stumble, then they only go down a certain amount because so it limits your downside risk because potentially people could buy it. So you've got that put, haven't you? And you've got all the upside as well. So it's a nice risk reward balance there.
Yeah, you hope so. I mean, things like, so for instance, I would say Genus definitely feels like that at the moment. And even if you look at the upside downside, I would say on the PERS getting approved and brought forward, I think your upside is much bigger than your downside because of where shares are valued.
Yeah.
The slight caveat I'd say to the like risk reward across the whole portfolio would be the macro impacts we saw last year.
Yes.
So while you would say that about, great global leading assets last year, the difference was that like the market just derated quality growth stocks like we've probably never seen before.
Yeah.
So I think that didn't work in terms of that risk and downside last year. Actually, what's produced is some very attractively priced quality growth businesses which are still delivering, resilient and growing earnings, just like they were 2 years ago, maybe better in many cases, but they're on half the rating they were.
Yeah. Good. Okay. Well, now moving on to another sector, the gain is probably on half the rating that it was, and it hasn't actually had a bounce. It's asset managers actually, and you've got Tatton and Liontrust there because I mean, there's sort of like the sort of traditional sort of valuation model is a percent market cap over the assets under management, and that's sort of like re-rated downwards massively. Do you want to take us through sort of like Tatton and Liontrust? Because it's a consolidating area, isn't it?
Yeah, definitely. I mean, the whole space has seen consolidation. I think Tatton's really unique. So we probably owned Tatton for maybe 2 or 3 years now. A really great business taking market share consistently, and such a high quality management team. So founder run business. The two poles, the CEO and CFO, and Lothar, I think really have a very strong strategic view on what they could do in this space. And sort of MPS has just been a really big growing area of the market. So I read actually, because I mean, the other thing about Tatton is we've seen really positive chat on MPS out of also peers. The whole space is growing really well. And I think that's helped as well by regulatory drivers. You know, it's helped by also sort of more assets coming back onto platform. It's helped by also advisors having to be more, because of the regulation we've had, you know, more reticent about, you know, best value propositions for clients, which also drive you towards looking at cost, and MPS stacks up really well there. So, I mean, I saw, I forget what it's called, I think it's called Platform, which is like obviously in you know, industry data, talking about 25% growth per annum going forwards for the next 5 years, or next 4 years maybe, in MPS is their expectation.
And what's for investors? What is MPS? What's this now? Manage something, I guess.
Yeah, portfolio service, I think so.
Yeah, okay.
So you know, it's a really good way that we're seeing more of those sort of like IFAs essentially use this as a, you know, it gives them confidence that they're using a specialist who is doing, you know, all the structured underlying research in terms of fund recommendations and putting together a very attractive and low fee, you know, proposition. And I think that's really attractive. So I think, you know, Tatton now, I think they've got about 800 IFAs.
Yeah.
Who now use their solution. And they'll have different buckets. So they'll have different sort of risk managed offerings. For so that, you know, IFAs are still able to select what's right for their end client. Yeah.
Well, I'm guessing they're probably, if they've got a really good platform and they've got really good sort of technology, then they'll be right up there in the crosshairs of consolidation, I guess.
Yeah, maybe. I mean, it's obviously a founder-run business. I think Paul's pretty passionate about what he can do with this business and taking it forward. But you know, it's really scalable. So I think they'll continue to improve margins. I think it's really attractive return business.
What about Liontrust? Because it does actually trade at a slightly lower valuation, doesn't it, in terms of AUM?
Yeah. So I mean, Liontrust, I think another great business. You know, really interesting sort of boutique style model almost that they've then expanded into sort of multi boutiques. I would almost describe it as. Another great management team. And a really good culture as well is one thing that sort of I think I've observed at both of those businesses.
And is Liontrust bidding for, is it GAM or something? Yeah, okay.
Which is one I think, you know, the market's been more cautious about that recently because Liontrust historically had probably done smaller acquisitions, you know, really almost hiring in teams essentially, but sometimes done through acquisition, so sort of best of class.
Yeah.
And I guess we've seen them do, you know, a couple of deals more. So they did Architas and Majedi, and some of those have proved more troublesome, I think, in terms of sort of asset retention and, you know, I would say just unfortunate market timing as well. But I think given that the market's a bit more cautious about just how big an acquisition GAM would be, and just the complexity of that, you know, it's a multi-geography type business. It's also got a fund administration business, which I'm not sure Liontrust would want. Yeah, okay. You know, so you've got a bit of, I think you've got a lot more management workload on making that deal work.
Well, it's got a very big, it's got a secure balance sheet. It's well cashed up, and it's on a 10 times PE multiple, so it looks very, very, very cheap to me.
Yeah, and also, you know, its flows have been, you know, pretty resilient through the sort of past 18 months of market turmoil as well. You know, I think they've done quite well. They've, I think they've got a more diversified portfolio as well now, which should sort of steady them, let's say, through market volatility and through when different asset classes are perhaps in vogue or not.
Yeah, okay. What about, just to move into sort of food and drink ingredients, we've got Treatt, which again is a perennial sort of like trophy asset that people have a look at because it's a high quality flavors and fragrances business. I think largely for sort of like things like drinks and stuff like that. And they've got a turnaround, which is in Hilton Foods. Do you want to take us through both of those? But similar sort of like, well, in the sort of the edible area, but in different margin perspectives.
Yeah. So, I mean, let's do Treatt first.
Yes.
So Treatt, sort of natural flavors and fragrances.
Yeah, okay.
And natural being the important word there, because that's a big sort of underlying market driver. And Treatt is a business which had been performing really well, been always met or always beating expectations. And then they really saw a hiccup last year, which unfortunately cratered shares, which was around a customer who was looking to do alcoholic iced tea was the product. And I think it showed maybe a slight naivety about the sort of business in terms of just the internal judgment about the volumes that were going to come from this customer and product. And basically this product wasn't really taken on by the market, didn't do well. Now this same customer, was already a customer of Treatt, had some great products. They'd always, when they'd spoken about new product innovation before, it had done well and they got it right. So I guess that's where they sort of had their expectations too high. But anyway, so that really was a hit for Treatt short term. But I think we're seeing them bounce back now. So their latest sort of quarterly growth numbers saw a big reversion of growth. I think they've got great opportunities. So we sort of talk about the 4 C's: China, coffee, citrus, and cocktails.
Oh, okay.
Yeah.
Not a bad combination.
Yeah. So, I mean, I think these are all sort of good, attractive growth opportunities for Treatt. They've really invested in their facility. So I went to see it last year, Bury St Edmunds, that's where it is, which is a huge step up from their old facility. And they're really seeing the sort of customer appreciation of that, so the type of work that they can win with sort of more blue chip clients from this. I think I'll see them invest in their US facility as well in terms of upgrading, but it's been a difficult time for them. I think they're past that hurdle of the UK investment. I think things are now, they're sort of stabilizing the ship. I think they've got a really good new CFO, Ryan, who's I think really done a lot of work in terms of looking at just some of the processes and working capital. And I think he's really going to improve a lot of those elements.
Yeah, and as I say, that's quite a sort of oligopoly type of industry because it's very specialist and very niche. And I wouldn't be surprised if somebody has a go at those guys at some point in time.
Yeah, I mean, I guess the valuation, because of everything they've been through recently, is a bit punchy.
Yeah.
In terms of just, it's not going to be a cheap asset, let's say.
Yeah. What about Hilton Foods?
Yeah,
because that's obviously that's the peak. It's all meat, isn't it? It's multiple retailers, sort of like whether it's seafood and beef and pig and whatever it is.
Yeah, yes, we sort of simplify Hilton as being beef and fish.
Oh, okay, beef and fish.
I'm doing them a discredit because they do more products than that.
Yeah.
Hilton Food is basically, I mean, what it's really good at is sort of sourcing, preparing, and packaging product.
Yeah. And
that's where we've seen them expand out over time. So, for instance, they didn't used to have any fish protein. They've done that through 2 sort of acquisitions. And it's a business which is increasingly globalized. So really present in a huge number of geographies across the world now. And the challenge Hilton had last year was that Hilton was seen as a very sort of dull, defensive business, but reliable. And they'd really done a lot of work. If you look at, I don't know, Hilton 10 years ago, similar actually to what we would have seen with Cranswick, another food producer, is that the quality of the contracts that these customers have, that these companies have, is much, much better. So it means that the businesses shouldn't be subject to like unforeseen inflation, cost changes, things like that. It's sort of much more pass through now. And the thing that Hilton saw last year was that although that was true on the beef part of their business, some of those contracts were not as high quality in the seafood business, which they'd acquired. So salmon prices basically doubled intra-period last year. And on top of all the other logistics, energy type inflation, they just couldn't pass it on. The contracts weren't there to do it. And also if they had, you would have just killed short-term the demand on the shelves. So we saw them take a bit of a hit on that and work their way through improving those contracts with customers. So the big customer in that space is Costco.
Yeah, okay.
Actually, by the time we got to the end of the year, they had they'd really got through all those problems. They were confident they were back onto the same sort of growth potential pathway. They'd improved the margin potential. So they'd essentially resolved, they think, all those issues. And a business which is still winning attractive new contracts. That are an interesting thing in Singapore with a business called Country Foods, which could open up that region importantly. And we've also seen them announce a really high quality new CEO who has worked, well, he's worked in Tesco for many years, but importantly, he has run the Co-op, which, don't forget, the Co-op isn't just your sort of local high street stores. You know, the Co-op is a real conglomerate of all sorts of businesses. So I think he comes with a lot of experience.
Good. How much pricing power has Hilton Foods got? Because that would be my biggest. When I shop sort of online with Tesco's, they sort of give you, on your Tesco's card, 25% off your salmon or your beef or whatever it is, and that's pretty tough to compete against, particularly if they're sourcing it themselves from their own farms and stuff like that.
Yeah. So they don't like vertically integrate right down to the supply. So they're buying in the product, but they do. So they have and they don't have pricing power. Like, if you work in this sort of industry where the supermarkets aren't making high margins,
yes,
you're never going to be a super high margin business. But they do have pricing power in terms of those contracts. So that's what we saw in like beef, is that the contracts, for instance, have all like inflationary cost pass through. So the supermarket pays whatever it costs, essentially, absorbing all those costs, which gives Hilton a sort of, a not bumper margin, but should be, apart from the seafood issue, should be quite a stable margin. And the other thing we see is, look, they work as well. These companies always work with the supermarkets on that promotional activity as well, because you have a sort of pricing versus volume argument there as well. So it's a real one thing I would say is real relationship. Like, say for instance in the UK, like Tesco, Hilton Food Group is so important to Tesco. They do practically all of their beef.
Okay, right. Okay, well, it's much better quality than it was sort of 20 years ago, that's for sure. So that must be because of Hilton Foods. Well, and moving on to, you haven't got that much actually exposure to energy, but you've got Energean, which I think is a oil and gas explorer, largely in the Mediterranean, places like Greece and Egypt and offshore in Israel, bit in the North Sea. It does trade on a ridiculously low valuation of 4x PE, but has got a big chunk of debt as well.
Yeah, so resources is typically not a big sector for us, but a lot of these businesses screened quite well last year in terms of quality growth momentum. And a lot of them, when we did the fundamental research, we didn't feel comfortable with some of the volatility potential, some of the governance side of things. Actually, energy, we got reasonably comfortable with. And I think it's best known for its operations off Israel.
Yeah.
And we're seeing that now, so we're past the sort of big investment spend. We're now onto that production cycle. So importantly, your cash flow generation is really ramping up from here. And one of the good things about Energean is they've essentially fixed the commodity price.
Oh, right.
So they shouldn't be subject to any commodity price volatility. So you know that price you're getting for your production. And for these guys, I mean, although they do have debts, and they're probably about 2x-ish net debt EBITDA.
Yes, slightly less, but you're right, about that sort of level,
But importantly, like now, I think you've got quite a lot of visibility. Now production is ramping up, and they're actually generating revenue. You've got quite a lot of visibility of that being paid down. So I think they generate about a 20% free cash flow yield per year. It pays an 8% dividend yield. It also, so I think it pays about $50 million per quarter dividend. I think people think that can double when production is ramped up. So it's I think it's quite a unique sort of cash generative shareholder return type story in the space.
Is it mainly gas offshore? Okay, so that's really key, isn't it, for Europe as well? For that zone. So it's not only is it hedged its gas, but actually it's got a runway there for supplying gas into Europe, into Germany for years, I guess. Yeah,
well, and there was an interesting bit of news flow from peers. So I think it was, I'm not an expert on this space, but it was I think BP and ADNOC were looking to buy NewMed, which is also in that area. So sort of Israel, offshore Israel, Cyprus type area. And actually, I think one of the positives for Energean going forwards would be if you had a pipeline into sort of Cyprus, because that opens up international pricing areas. And actually the support of other people operating in that space, I think, is going to be helpful in terms of sort of getting that approved and rolled out. Yeah,
energy security. I mean,
and it gives a lot of, because and us included, when you first look and it's offshore Israel gas, you're going to have a few questions around that. But I think actually the interest of people like BP and ADNOC as well gives a like positive sentiment to the quality of that asset base. Yeah,
I mean, it seems to tick all the boxes on energy security for Europe, particularly with the Ukraine-Russia sort of like, war still sort of like, ticks through. And it would be going full circle, really. You're remiss of me not to mention the consumer. And you've got Hollywood Bowl, which I think came out with a bit of a blockbuster set of results. So like, as you mentioned, do you want to take us through your latest thoughts on this one? Tempin Bowling, I believe. Yeah, so Tempin Bowling actually has mini golf operations as well. The Putt Stars. Okay. And they've only got a sort of handful of those at the moment in the UK, but they'll roll out more of those. Yeah. So yeah, I mean, I think it's been a great operator. So I think, one of the highest quality management teams I have. This is not an easy, like leisure is not an easy place to run a business in. And actually, I think these guys have led by example in that. And I think one of the greatest things about Hollywood Bowl I see is the culture that they have, the amount of sort of training and development, how face-to-face management are, like they host some of the training sessions. In COVID, when everyone was short of staff, the CEO and the CFO are working at some of the sites. Wow. Yeah, so really, I just think a great culture around a business. And I think what we've seen around them is they've really invested in understanding their customer more. So invested in CRM solutions. It's allowed them to do things like dynamic pricing. So, typically, I don't know, 10 a.m. on Monday is not peak time. How do you get people in and really maximize your assets that you have? And I think one of the interesting things that we like about businesses is where they can take something into a new geography, and that elongates that investment case. And we've seen them do that in Canada. So a really sort of low risk acquisition in terms of sort of capital deployed into Canada, which they describe as being like the UK bowling market was, 10 or so years ago, really underinvested. But actually quite a big market. So I think there's half the number of bowling sites in Canada than there is in the UK. Wow. So, quite a big opportunity. And, Canada geographically is interesting, isn't it? Because it's basically all along the border. So actually, although it's a big country, people are quite condensed, and I think they're doing a really good job to understand, how the market's different there. So things that you might need to do differently, like league bowling, for instance, is a big thing in Canada. But also just there's so much like best practice they can take from the UK into that business. You'd have thought actually, to monetize bowling and to make it, because you've had so many sports which are sort of like have been around for ages, but are pretty exciting in terms of particularly league and competition and experience and this sort of stuff. There must be a way of sort of monetizing that in a broader sort of like environment. Maybe linking up with LBG. Yeah, I mean the UK is really much more of a consumer space for bowling, and one of the best things about it actually is it's like family friendly. Your whole family can go bowling. It's an attractive value for money sort of proposition actually to take a family. So I think the league bowling's a bit different. They're a different personality to deal with and keep happy, let's say. Yeah, good. Okay, well, thanks very much, Abby, for the brilliant insights, as always. If anybody wants to sort of invest in Aberdeen in your funds, how best to do it? Yeah, so we have a range of funds which are available on all your traditional platforms. So Amanda Yeaman and myself run all the UK small cap and all the UK mid cap portfolios. So take a look. Brilliant. Okay, well, thanks very much, Abby, and hopefully see you down Hollywood Bowl at some time. Throwing a few pins down there. Thanks so much. Bye. Thank you. Bye.